Well, everyone, my next guest is Peter Schiff. He's been a great friend of ours. He's been on many of our programs, and I couldn't think of a better person to be on with this whole renegade theme. He's without a doubt one of the champion renegades in the economic space in the world. Look, he is an American financial commentator, radio personality. He's a gold specialist. Peter is a well-known economist and the media love him. He's always seen on all the leading radio and television programs. I see him all the time. I love his radical views. I love how enthusiastic he is about what he believes in, and that's why I got him on this program. Peter lives in San Juan, Puerto Rico, and so we welcome Peter. Are you there?
I am here. I'm here. Thank you for the introduction. Not quite in San Juan, but close, at a town called Dorado. I don't know that I'm really a renegade in my beliefs. I think everybody else is a renegade. My beliefs are true. And I think what's happening is history is bearing me out here. So I think the mainstream is going to have to bend and realize that they've been radical the whole time. And what I've been saying has just been the truth.
Yeah, but the way that you explain yourself, the way that you come across, comes across very forceful and very direct and very straight and very powerful. So that's why perhaps I said that. But at any rate, let me leave the program over to you for the next 30 minutes. So thank you, Peter.
Okay, just setting my timer just to make sure. Anyway, welcome everybody to this event. And I want to talk today about the word that's on everybody's lips these days and on everybody's mind, and that is inflation. Everybody is talking about inflation, but I've been talking about inflation for over a decade now. Inflation didn't just suddenly creep up out of left field in 2021. Inflation has been the problem the entire time, except that central bankers and governments relied on inflation as the solution to their problem. In fact, for the last decade, the one thing central bankers seemed to agree on, whether it was in Japan or in Europe or here in the United States, they agreed that the problem with inflation was that there wasn't enough of it. We just didn't have enough inflation. Prices were rising too slowly, and that was a problem that the central banks were determined to solve. They were going to do whatever it took to increase the inflation rate up to 2% per year, because 2% was what they claimed was the holy grail of inflation, that inflation must be 2%, prices must go up by 2% every year, and if they don't, well, this is a huge problem, and the central banks need to solve this problem with radical monetary policies. Even if it meant negative interest rates, they would do that in order to make sure that the cost of living went up by 2% per year. Now, to average people, this would sound absurd. Why does the cost of living have to go up by 2% a year? And if it only goes up by 1% a year, why is that a problem? Why does it need to go up faster than that? Most people would rather the cost of living go down. If food got cheaper, people would like that. If their rent went down, everybody would love that. If your landlord said, hey, we've decided to cut your rent this year, nobody would object to that. What if, you go to the gas station and the prices are lower? Good news. What if college tuitions went down? What if medical bills, instead of going up, what if they went down, right? Everybody would love that. Everybody likes it when the things that they want to buy, the things that they need to buy, become more affordable. So why was it a problem for the central banks that the stuff we needed to buy wasn't going up in price fast enough, and it needed to rise faster? And first of all, where did they get this 2% figure? Why is 2% so great? Why not 1.5%? What's wrong with that? Or 2.5%? I mean, why is 2.5% too high and 1.5% too low? Why is 2% just right? And the answer is it's not. 2% is not better than 1%. It's worse. 1% is better, and negative 1% is better than positive 1% when it comes to prices. But the way this 2% target came about was years ago, many central banks began implementing 2% inflation as a ceiling. What the central bankers were telling everybody was that we're going to keep inflation below 2%. If it gets up to 2%, we're going to take action because 2% is our ceiling. We don't want it to get above 2% a year. So as long as it's below 2%, everything is okay. Gets to 2% or higher, we're going to spring into action to make sure it comes back down. Well, somehow along the way, that 2% ceiling became a target where central banks said, we need to get up to 2%. That was never their mandate. No central bank had a mandate of making sure inflation was 2%. It was just making sure inflation was below 2%. That didn't mean that if it was 1%, they had to try to get it up. They would just say, oh, it's 1%. That's great. It's below 2%. We succeeded. But they completely changed. Why did they do that? It was all a pretense. The central bankers were faced with some serious economic problems that they didn't want politicians to have to deal with. Countries had run up a lot of debt, and the governments really didn't have the ability to pay all this debt. And so what central banks did was lower interest rates to make that debt affordable by lowering the interest payments on that debt. And that allowed governments all over Europe, governments in the United States, to continue to pile on debt without having to make any difficult political choices of raising taxes or cutting spending. But also, because central banks kept interest rates so low, it wasn't just government debtors that were able to go deeper into debt. It was the private sector. Corporations, individuals, everybody loaded up with debt. And the more debt everybody took on, the more the Federal Reserve and other central banks felt compelled to keep interest rates artificially low, because allowing interest rates to rise would have caused a financial crisis. A lot of people would have defaulted on their debts, including governments. And so the central banks kept interest rates low and kept printing money. Now, they called it quantitative easing, but quantitative easing is basically a euphemism for inflation. That's what it is. When the Federal Reserve launched quantitative easing for the first time in 2009, what it really decided to do was monetize government debt and create inflation. That's what quantitative easing was all about. It was about inflation. And in fact, the central banks justified quantitative easing and negative 0% interest rates because they said these policies were necessary to raise the inflation rate. Inflation was too low. So central banks recognize that these policies were in fact inflationary because they were designed to cure the problem of too low inflation. But that problem didn't exist. All they did was pour gasoline on an inflation fire. Now, inflation didn't really rear its ugly head in a way that became a big problem until last year. And that's because these monetary policies operate with a lag. And what surprised me was the length of that lag. The inflation that we're experiencing now in 2022 really started in 2009, 2010. We haven't even caught up to the inflation we created in 2020. That's coming. But there's all this inflation in the pipeline. Now, another reason that inflation did not become as big a problem is because the way the money entered the economy in many cases was through the banking system, through the financial markets. So the prices that were impacted the most by inflation were stock prices, bond prices, real estate prices. And so people didn't mind when inflation was making them richer. In fact, people like that. Politicians like that. Everybody likes a bull market. So when inflation is first entering the economy and the first impact it has is on asset prices, nobody's worried about it. And so the central bankers kept creating it. The other factor that was important was the fraudulent way that governments measure inflation, particularly here in the United States. I'm more familiar with our CPI, but I think other CPIs in other countries are similarly flawed by design. But the increase in consumer prices, the way it's officially measured, is not nearly as great as what is actually experienced by consumers when they're buying goods and services. So if you have an official measure of inflation that says prices are going up by 1.5% a year, it's possible they're going up by 4 or 5% a year in reality. And so when the government says, hey, we don't have enough inflation, we got to get that 1.5% inflation up to 2%, what they're actually doing is getting that 5 or 6% inflation rate up to 10%. Now, where we are today, you've got nations all around the world reporting official inflation rates at 8%, 9%, 10% or more, which means the unofficial actual rate of inflation is probably somewhere between 50 and 20%. So inflation is an enormous problem all over the United States. Look, I just got the other day my new premium for my homeowner's insurance policy for my house I have in Connecticut, and it was a 38% increase over the prior year. I mean, that dwarfs what the government says inflation is. And the reason my insurance premiums went up so much is because they said the cost of replacing the house, if it burns down, has gone up so much. Because of the increase in raw materials and labor costs, it's going to cost 38% more to rebuild my house than it would have cost to rebuild the same house a year ago. That's what's going on in reality. And I've experienced in my personal life, and so have so many other people that email me, price increases that dwarf what the government claims is the increase. In fact, speaking of housing, in the United States, when we measure consumer prices, we don't use rents. We don't use home prices. Home prices are up something like 40% since the beginning of COVID, 30, 40%. Rents are up maybe 20%. But according to the government, they use something like owner's equivalent rent, and that's only up 6%. Well, what is owner's equivalent rent? Doesn't matter because nobody actually pays it. It's a made-up number that the government puts into the CPI so that it can pretend that shelter, which is a third of the CPI, is rising at a much slower rate than it actually is. So now inflation is a huge problem. See, inflation was the government's solution to the problem until inflation has now become the problem. So what is the solution to the inflation problem? There is none, at least none that is politically acceptable. And so inflation is going to get much worse. Forget about what these central bankers and politicians are saying about their commitment to fight inflation, how they're resolute and how they're determined no matter what to bring the inflation rate back down to 2%. That's never going to happen. We're going to see 20% inflation before we see 2% inflation. And this pretend war against inflation is going to come to an end soon. And the central banks are going to surrender and inflation is going to win. Look, we've already seen the first central bank capitulate and wave the white flag, and that was the Bank of England. The Bank of England, a week or two ago, was every bit as committed to fighting inflation as the Fed, until the inflation fight threatened a financial crisis, and then they cowered out, turned around, and they're back to quantitative easing. They went from quantitative tightening to open-ended quantitative easing. In fact, the Bank of England said, we're going to print as many pounds as we have to. We're going to keep on buying gilts. We're not going to let interest rates go up. They have to let interest rates go up. If you want to fight inflation, you got to let interest rates go up. But the other thing you have to do to fight inflation is to make government spending go down, because government spending is the source of that inflation. Governments are running deficits, and the central banks are monetizing those deficits by creating inflation. Governments are actually funding themselves through inflation. When you have a budget deficit, you're not getting government for free. Every nickel that the government spends has to be paid for by the citizens. And if they don't pay for it with a tax, then how are they paying for it? Through inflation. So when prices go up, that's the tax that you're paying for all these government programs. And so if the government wants to get rid of inflation, well, then it has to get rid of those programs, or it has to raise taxes to finance those programs. And that's not happening. That's not happening anywhere. Nowhere in the world, despite all these governments that claim they want to fight inflation, no government is actually doing it. Nobody is cutting spending. In fact, in the UK, they cut taxes. Well, when you cut taxes, you increase the inflation tax. So the British were claiming that they wanted to fight inflation, while at the same time creating even more of it. That is the problem. But the same thing is going to happen to the Federal Reserve in the United States. You cannot raise interest rates without creating a financial crisis. The financial crisis we had in 2008 was a result of a normalization of interest rates. It wasn't simply a subprime problem. The reason subprime was the problem was because it was debt. People borrowed money and they couldn't pay it back. Why were they able to borrow the money? Because it was cheap. The Fed lowered interest rates to 1%. They created a housing bubble. Housing prices went up. People borrowed money against those inflated property values. They borrowed money with artificially low interest rates. And when interest rates went up, property prices went down. People didn't want to pay their mortgages. You get a financial crisis because now the banks didn't get their money back. They loaned all this money out. They didn't get it back. That was why we had a crisis. Well, today we have much more debt than we had in 2008. We had 0% interest rates for almost 10 years. Think about all the debt that was taken on during those 10 years by not only the government, corporations, private citizens. Do you think they can repay that debt when rates normalize? Of course not. And what happens when rates go up, asset prices come down. It's like the other side of a seesaw. The lower interest rates are, the more expensive stocks are, the more expensive real estate is. But as interest rates go up, those prices come down because it's all a function of interest rates. So if I borrowed a bunch of money to buy a house and now the house goes down, I have no equity and my mortgage payments are up, I'm mailing in the keys. But you have all these companies in America that have been losing money. In fact, in 2021, it was a record year in America for money-losing companies going public. Now, how do all these money-losing companies stay in business? Because the company is supposed to generate a profit to stay in business. How do you lose a bunch of money and still stay in business? How do you pay your employees? How do you pay your rent? Right? How do you do anything? Well, the companies were selling stock to the public. They were raising money by selling stock, and a lot of companies were borrowing money to pay their expenses, taking on debt. But it was all great when rates were at zero and people were willing to buy these overpriced stocks when rates were at zero. They're not willing to do it when rates are at 4%. And in order to fight inflation, they got to go much higher than 4%. Despite the rate increases, federal funds rate in the United States right now is about 3.25% to 3.5%. Inflation, even the way the government measures it, is 8.25%. That's negative 5% real interest rates. You're not going to fight inflation with negative 5% rates. You're going to create more inflation. The only way that you can fight inflation with higher interest rates is if the interest rate is higher than the inflation rate. And it can't just be a little bit higher. It's got to be meaningfully higher. In 1981, when Paul Volcker raised interest rates or allowed interest rates to go up, short-term rates went to 21%. The highest inflation got was 13.5%. So that's what it took. People had real interest rates. The reason you need that is because you've got to stop people from spending money. That's what's the demand. It's spending. You've got to get people to stop spending and start saving. because that accomplishes two things. It reduces demand, but it increases supply. How does it increase supply? Well, when you spend money, when you save money and you don't spend it, that money can finance capital investment that will lead to more production of goods. And so you increase the supply of goods while decreasing demand for goods, prices can come down or stop going up. That's what you need to do. Now, if interest rates are negative, that is not going to encourage anybody to save. If rates are negative 5%, you're going to lose 5% a year on any money you save. Why the hell would you save? You wouldn't. You're going to spend your money as quickly as you get it. You're not going to save it and lose 5% a year. Now, if the Federal Reserve raised interest rates up to, let's say, 10% or 15%, then you might save your money. Hell, I could put my money in the bank and earn 15%. I'm not going to spend it. Even if inflation is 8%, I'm still 7% ahead. I'm going to save my money. I'm going to earn all that interest. I'm going to spend my money in the future because then I'm going to be able to spend the interest that I earned on my money. That's what the Federal Reserve needs to do. But they're not doing that. Also, we are running $2 trillion a year deficits in the United States. Where's the money coming from? Right? It's coming from the Federal Reserve, or it was, and there's no other source, because if the Federal Reserve isn't going to print all that money, then the private sector is going to have to buy all those treasuries. But the private sector doesn't want those treasuries. Foreign central banks don't want those treasuries. They need to sell the treasuries they've already got. They don't need to buy any more. There is no way to finance these deficits, so the government has to cut spending. But they haven't cut any spending. In fact, if you look at the Inflation Reduction Act, that was a spending bill. They increased spending to fight inflation. How are you supposed to do that? It's the spending that is the source of the inflation, because the spending is being monetized by the central bank. So instead of fighting inflation, they created additional inflation. Instead of putting out the fire, they poured gasoline on the fire and just pretended that they were going to put it out. But everything we're doing, we're forgiving student loans. In fact, we told people that have student loans, you don't have to pay those loans. Just go out and spend the money on other stuff. Buy more goods, buy more services, push the prices even higher. You see, the Federal Reserve and other central banks are at an inflection point. They're really in a situation where they're between a rock and a hard place, and they're damned if they do and they're damned if they don't. Because for years, they were able to kick the can down the road by creating inflation and sweeping the problem under the rug. But now that inflation has become the problem, they can't solve the inflation problem by creating more inflation, because the solution to every problem has been inflation. The economy is weak, print money, lower interest rates. Companies are failing, let's bail them out. How do we pay for that? Print money, create inflation. So inflation has been kind of the one-trick pony. It's been a cure-all. Whatever ails us, just inflation is going to be the cure. Well, now that inflation is the disease, where's the cure? There is none. Any more stimulus, and we end up with an overdose. And that is where we are right now. And what's keeping everything going, the reason that we haven't already seen a collapse in the bond market or a collapse in the value of the US dollar, the reason we've had a rally in the dollar is because the world is still has faith in the Federal Reserve. The world still believes that the Federal Reserve is serious about bringing inflation back down to 2%, and that it has the ability to bring inflation back down, but it doesn't. Remember, it was the Federal Reserve back in 2008 or 2007 that said not to worry about the subprime market. It was contained. Of course, we saw how contained that was. But even before the subprime problems, they told us there were no problems. They said there wasn't a real estate bubble. And they said even if the real estate prices went down, it wouldn't hurt the economy because it was so strong. So the Fed has a very bad track record. And more recently, with respect to inflation, first the Federal Reserve said we didn't have enough inflation. Then when inflation got to 2%, they said, oh, well, we need to have it a little bit higher than 2% to make up for all the years that it was a little bit below 2%. And then when it got much higher than 2%, they said, don't worry about it, it's transitory. It's all going to go away on its own. And they said that for a year as inflation got worse and worse and worse until they finally admitted that it wasn't transitory. And so now they're claiming that they're going to solve the problem. But that's another lie. It's just like the transitory lie. They knew inflation wasn't transitory. So why didn't they admit it? Because they couldn't fight it. Because they knew that fighting inflation would crash the house of cards that was built on a foundation of inflation. Everything the Federal Reserve has done has been to artificially prop up an overly leveraged economy. Well, the minute they try to fight inflation, they knock out those props and everything comes collapsing down. That's why they pretended it was transitory, because they didn't have the guts to do something about it. It was only when the problem became such a big political hot potato and everybody was worried about inflation that the Federal Reserve finally said, okay, we're going to do something about reining in inflation, but they don't have the ability to actually live up to those commitments. Now they can pretend and they can hope that inflation just goes back down to 2% all by itself because they're talking about how committed they are to bringing it down, but they can't do it without creating a financial crisis. In fact, the rate hikes that they've already delivered, even if there's nothing else behind it, will create a financial crisis. It's just a question of how much time. See, it already happened in the UK, or would have happened, and we're very close to that point now. But also, inflation is going to keep getting worse. Remember, as inflation was getting higher and higher in 2021, and then again in 2022, they kept saying peak inflation. Every time we had a little downtick in the headline inflation rate, they were like, okay, it's over. Inflation has peaked. And then you'd see another new high in inflation. And so right now, people think, okay, we're going to get a little bit of a reduction from the numbers we had. That's probably true. I mean, you always get some type of ebb and flow. I mean, nothing goes in a straight line. So maybe the 8.5% year over year inflation will go back down to 7% or 6%. But then the next thing you know, it'll be 10% or 11%. It's not going back down to 2%. And at some point, the investors around the world are going to realize that once again, the Fed is wrong and that inflation is never going to go away. Inflation is here forever. And that's when the bottom drops out of the U.S. Treasury market, because right now the yield on a 30-year U.S. Treasury is still well below 4%, even though the inflation rate is double that. And that's at 30 years. Why would somebody want to lend the U.S. government money for 30 years at 3.7% when inflation is already 8%? It's only because they believe it won't stay at 8% for long. They think it's going back down to 2% and it's going to remain there for most of the next 30 years. That's not going to happen. The fact that we had 2% inflation in the last decade, that's the aberration. That's never happening again. We're going to have massive inflation because governments are committed to massive deficit spending. They've taken on so much debt. The United States has a $31 trillion debt right now, and it's already impossible to pay that debt. And it's not like the U.S. debt is financed with 30-year bonds. It's financed with one-year T-bills. All this debt is maturing. You've got debt that the government took on at 25 basis points that it's rolling over at 400 basis points. That's a 16-fold increase in debt. And so when the world realizes that inflation is here to stay and that it's going to get worse, not only will the bottom drop out of the bond market, but out of the U.S. dollar. This whole dollar rally is based on the Fed winning an inflation fight. And every time we got worse inflation news, the markets just thought, okay, that means the Fed's going to fight harder to win. The markets haven't come to the conclusion yet that higher inflation just means the Fed is losing. And eventually it's going to surrender because it's going to have to turn its attention from the problem of inflation to the even greater problem of a financial crisis and a depression. And when Powell first started talking about the Fed's resolve to fight inflation, it was predicated on the fact that the U.S. economy was so strong that it could take the fight in stride, that we could raise interest rates and not hurt the economy. We had this super strong labor market. Well, we've been in a recession all year in the United States, as much as Everybody wants to deny it. We've been in one. It's going to get a lot worse. And once the Federal Reserve accepts and the public realizes how weak the economy is, then inflation is going to take a back seat to trying to solve these other problems. But solving the other problems is going to mean making the inflation problem, which is already bad, worse. You see, when we had the financial crisis and then when we had the COVID crisis, inflation was still officially below 2%. So the Federal Reserve could get away with quantitative easing. They could get away with 0% interest rates because they were able to say we can do this because we don't have enough inflation. But when they try to do it again, when the problem is too much inflation, they no longer have an excuse for creating inflation. And when they try to do that, it's going to blow up because then you're going to have a dollar crisis. Then you're going to have a sovereign debt crisis. And that is a whole new level of financial crisis. And what that also means is that the investments that did well in the aftermath of the 2008 financial crisis, or the ones that did well during the COVID rally, none of those investments are really going to work out. Those types of investments, high multiple companies, companies that have no earnings, these companies are going to deliver losses. What you have to own as an investor are real inflation hedges. Companies that earn money today, not that may earn money in the distant future, because no one's going to pay for some potential distant future earnings in a high interest rate, high inflation environment. Even if the central banks are keeping interest rates artificially low on the short run, long rates are going up and inflation is going up even more. So you have to own real businesses. And because inflation is going to be so pernicious, consumers are going to have to cut back on just about everything they buy. And so what they're going to have to be buying are the products that they need, food, energy, things like that. So you want to own companies that sell goods and services that people have to buy, not what they buy after they buy what they have to buy, because they're not going to have anything left over for that. You got to get out of US dollars. You got to get out of US stocks and bonds. You got to get into precious metals, gold and silver, mining stocks, other natural resource companies. These are the stocks that haven't done very well on a relative basis over the last 10 or 20 years as the Fed was inflating this bubble. They're going to be the ones that do the best as the air comes out of this bubble. Anyway, my alarm went off, so that means my 30 minutes are up. But if anybody is interested in hearing more about what I have to say, make sure and listen regularly to my podcast, The Peter Schiff Show. It's on schiffradio.com, on my YouTube channel, and contact the representatives at Euro Pacific Asset Management. We can talk to you about building a portfolio that will do well when the U.S. economy does not, portfolios that are meant to excel during stagflation. But more importantly, it's not just going to be stagflation. We're headed for an inflationary depression, and your portfolio had better be prepared for that. Thank you.
Peter, thank you so much for that. That was drenched in common sense and responsibility. I really appreciated what you had to say. And obviously you're saying there could be somewhat of a huge change. So thank you so much, Peter. Thank you for being part of the program. And we look forward to being with you again real soon.
All right, take care.